Fixed indexed annuities are some of the most misunderstood products in all of retirement planning. Some people say that they are the safest way to protect your money. Others say that they're a trap. So, which is it? I'm Michael Baker, and for nearly 2 decades, I've been helping couples build retirement income plans that are clear, sustainable, and aligned with their goals. In this video, you're going to learn 3 key things: what a fixed index annuity is, the advantages and limitations of fixed index annuities, and how a fixed indexed annuity may or may not be the right fit for your retirement income plan. So what exactly is a fixed indexed annuity? Like all annuities, it is a contract that is issued by an insurance company. However, this specific type of contract has some unique features that sets it apart from the different types. In this instance, it's called a fixed indexed annuity. The fixed portion lets you know that this type of contract is actually a principally protected contract, meaning it's not going to bear any type of market risk. The index portion, or the index part of the name, tells you exactly how this type of contract is expected to earn interest credits over the life of the contract. So, understanding the name, fixed indexed annuity, it's a principally protected contract where you are able to link your funds to various index options. We're not directly investing in the index, but the funds are linked to an index, and the way that you earn interest varies throughout the different types of contracts. But that's in a nutshell what a fixed index annuity is. It is a principally protected insurance contract issued by life insurance companies. So first, let's discuss the menu of options. Every policy or contract is going to have a menu of index options where you can allocate a portion or all of your funds to a specific option for the chance to earn credits. Let's take, for example, a very common option is the S&P 500. First, it's important to note that this index is most likely going to be the price return, not the total return of the S&P. Those are 2 very different things, but it's important to note that. And what you'll do is you will allocate a portion or all of your funds to that option. And depending on how the S&P price index does over a period of time, which is referred to as your crediting period, you may have a 1-year or 2-year. I've even seen 3-year crediting periods. Now there are even 5-year or much longer crediting periods. But to keep it simple for the sake of this video and this example, let's look at a 1-year point-to-point crediting strategy using the S&P 500. So we have a 1-year crediting period. We're going to use the S&P 500 price return. And the way this works is it's going to look at how the S&P 500 does over that period of time. If the S&P 500 price return is positive, then there's the potential for a credit. If the S&P 500 is actually negative, well, in effect, you will get a 0, meaning the index was underwater from the time the contract started. Well, we're not directly invested in the index. Our money is only linked to the index. And since it's a fixed contract, meaning there's no direct market risk, your worst case scenario in this instance on a base contract would be 0% credit or 0% return for that crediting period. Now let's talk about the different ways that credits can be earned. Again, this used to be quite simple, but now it's getting more complicated. There are caps and spreads, participation rates, and now there are even fees that go alongside some of these crediting options. So let's look at an example, because I think that's the easiest way to understand at least the concept. So let's take the S&P 500 annual point to point. Let's give ourselves a 6% cap. Okay, meaning we can earn up to a cap and our floor is 0. So in a year where the S&P price return was really positive, let's say it did 15%. Well, if we had a 1-year point-to-point cap and we had a 6% cap on what we could earn, well, if the S&P 500 did 15%, well, that 15% is greater than our 6, so we will get a full 6% of our contract value credited to the contract. That credited amount becomes principal and is locked in for the next go around or the next crediting cycle. If the S&P 500 was negative, right? Well, we would get a 0. Let's say, for example, the S&P had relatively a flat year. So the price return of the index was relatively flat and it did 3.5%. Well, that 3.5% is beneath our 6% cap. So we would get actually the full 3.5% credit possible to our contract. That credit becomes principal. And again, it's there for the next crediting cycle. Now let's look at a scenario where we're using a participation rate. Let's use a 50% participation rate just to keep the math easy. Okay, so we have 1 year credit, 1 year point to point, S&P 500 with a 50% participation rate. If the S&P did, as we said before in the previous example, let's say it did 15%. Well, 50% of that 15 is 7.5. So for that crediting period, you would get a 7.5% credit added to the contract value. That becomes principal and it's there for the next crediting cycle. If it's negative, we get a 0. What if the S&P had a massive year? Let's say it did 20% in a year. The price return was 20%. Well, 50% of 20 is 10. So you would actually get a 10% credit within that policy. Now, every one of these contracts, there are multiple insurers that use fixed index annuity contracts, and they have different index and crediting options. So it is going to be imperative, if you are looking at a fixed index contract, you want to understand, 1, what is the financial strength rating of the insurer? 2, what are the crediting options within the policy? For each of those crediting options, what are the limitations? How do they actually work? Is there a cap? Is there a participation rate? Is there a spread? Is there a combination? What is the fees? What are the fees potentially in the future? Could these crediting rates change? Most people don't understand that each and every year, insurance companies, unless they explicitly state that this crediting option is locked for the contract term, those crediting options may change. So you want to understand what's the history of those changes with this specific insurance carriers. These are all how you can evaluate the base contract for a fixed index annuity. Before we dig into the possible advantages or upside of fixed index annuities, let's talk specifically about some of the limitations. I think the first limitation that many people would point to within the fixed index annuity universe is that these are contracts that have a contract period and they come with a surrender charge. So if you have a 5-year contract, a 7-year contract, or a 10-year contract, or even longer, you want to understand exactly how the penalties work, because each and every carrier sets their own schedule. There are some regulations, so it is somewhat standardized, but you do want to know and understand what is the surrender schedule. If you have any type of restrictions or reasons to believe that you would not be able to have your funds in the policy for the duration of the contract period, you should really consider whether or not this is the right fit for you, because these contracts are designed to be held throughout the contract period. Now, there are liquidity provisions, but understand, you just want to know, like anything else, it can be very easy to get money into a contract or get money into some type of investment, even an investment strategy. But you want to know, okay, if I need access to my money, how does it work? If you feel like the surrender penalties are going to be a detriment to what you're trying to accomplish, then that may absolutely be a limitation that precludes you from wanting to use a fixed index annuity contract. Another limitation for these types of contracts is your upside or your earning potential is going to be limited. Because these are principally protected contracts, meaning your money's not directly invested in the market and your downside is going to be limited, well, your upside also tends to be limited. There is going to be a bound, or what I like to refer to as a collar. There's going to be your downside, which in the base contract is typically 0, and then your upside, there's going to be a limit what you can earn. That makes intuitive sense if you think about it. If you're getting protected on the downside, you're most likely going to be giving up something on the upside. One of the biggest criticisms of these policies is the way that they are often positioned. Many people that are selling fixed index annuities or pushing fixed index annuities will often tell prospective clients that these policies have the ability to earn market-like returns without the risk. In my view, I just think that that is an inaccurate framework on how to look at these contracts. Yes, I have personally seen periods where fixed index contracts have had double-digit credits added to the policy. I have seen really high single-digit years consistently in good periods with markets where indexes are rising. So yes, these policies are a powerful tool if positioned correctly. Another limitation now, especially, is that these contracts can be very complicated. They did not used to be that way. It used to be a very simple way to, have a very easy to understand crediting strategy. But as these companies have innovated and more people have gotten involved, more and more insurance companies have decided to get into this space. And as the baby boomer cohort has begun to retire en masse, there's been massive demand for retirement income vehicles. And so this space has gotten extremely complex. So it's very important to understand, like when you're looking at a contract, go back, review the keys that I gave you earlier. You want to know exactly the strength of the company. You want to know the menu of options. You want to know how they get credited. And you want to understand how long some of these indexes have actually been in existence. The S&P 500 is a very easy proxy, very easy thing to understand if you understand you're looking at the price return. But there could be, a very black box, weird, strange index that you've never heard of. Well, you want to understand, like, what is that exactly? When did that index come about? How did the crediting options work? Because some of these indexes are extremely complicated and you don't want to have buyer's remorse. Another potential limitation for these contracts is that liquidity could be limited. Now, most of the carriers, or at least most of the contracts that I've ever seen, there is liquidity provisions. There are liquidity provisions in the policy. Sometimes it's, a certain amount that you can withdraw each year on a penalty-free basis. Remember, these policies or these contracts have a surrender schedule. And the way that they often work is there is an amount, let's just use 10%. You might be able to withdraw 10% of your contract value in a year without any penalty. But if you were to exceed that penalty-free withdrawal amount, that's when penalties start to kick in. So for example, if you had a contract and the contract value was $100,000 and you wanted to withdraw, let's say 10%, you could get $10,000 of that contract out with no penalties. But if you decided to withdraw 15%, well, now we would have a penalty that would apply on that excess amount. These contracts are not designed to compete with the stock market for market-like returns with no risk. So they're not going to be growth vehicles that rival that of the overall stock market. I know that there are people that feel differently. I just disagree with that take. If you want a framework that I think makes sense, let's dive in and let's talk about the potential advantages of having a fixed index contract. First, the big advantage is these contracts offer principal safety or principal protection. So if you find yourself to be more conservative with your dollars now that you're approaching retirement and market gyrations and fluctuations make you nervous and give you heartburn, you're nervous about losing some of your money to a downside market event. Well, fixed index annuities offer principal safety, so whatever funds that are placed in these contracts are not going to be subject to market risk. A second thing to consider that I think could be viewed as an advantage is a properly structured fixed index annuity contract does have the ability to potentially earn more interest than a CD or a bond type alternative. In fact, I mentioned before that these contracts are often positioned as they are be able to compete with the market. I don't think that that's the appropriate framework. What I would say is that I think that there could be evidence to suggest that these could be bond alternatives. So not to be an alternative to the stock market, but if you were to look at a balanced portfolio where you're going to have stocks, bonds, fixed income allocation, I think you could make an argument that the fixed index annuity could potentially fit in there and give you a bond alternative and give you an additional degree of diversification in your portfolio. It's still important for you to understand exactly how the contract is going to work, but I do think that you could look at this as a potential bond alternative. And I think that that is a definite advantage for this type of policy. Like all annuities, if you are putting non-qualified funds meaning this is cash or money that might be in a brokerage account. So money that's not inside of a 401k or an IRA wrapper. If you're putting non-qualified money into the annuity contract, then any gains, any interest earned is all tax deferred. Now, it's also important that you know and understand what happens when we get money out of the contract. But in putting money into the policy, it can offer tax deferral. And if you are in a tax sensitive environment, or if you are specifically in a tax sensitive situation with your cash flow and your other sources of taxable income, and you're wanting to look for a way to mitigate or shelter some money from taxes, then a tax deferred approach using an annuity could be a solution. The big thing that fixed index annuity contracts have that most people are looking at to consider as it relates to retirement specifically is we have the ability to add income riders or living benefit riders to these policies, where we get to have what's called a guaranteed income benefit or a guaranteed withdrawal rate that comes out of the policy. You could set this up just like you could on other annuities, like we've talked about in the variable annuity video. These policies where you place funds into a contract, you have your base contract, you want to understand how the base contract works, but now you can add a guaranteed income benefit that could ensure your income for life or for joint life if you have a spouse. So for example, if you wanted to put some money into an annuity, you would have the base contract. You want to understand how the base contract is going to work. You want to understand the strength of that carrier, but then you may be able to add a joint lifetime income benefit that would give a guaranteed payment for you and your spouse for as long as either of you were living. What this effectively does is this allows you to create your own type of pension. In fact, if you will go and you look right now and you do Google search, a lot of pension plans are actually selling their plan over to insurance companies because insurance companies tend to be better equipped to handle these types of payouts than pension plans themselves. So let's talk about where fixed index annuities may fit in an overall retirement income plan. First, these tools offer principal safety. So if you have someone that is approaching retirement or nearing retirement and they're becoming more risk averse, right? The biggest risk for a lot of retirees is what I refer to as sequence of return risk, meaning you're right on the threshold of retirement and walking away from work, full-time work being optional. You've got your nest egg and you're most susceptible to a downside market event when you're in that retirement red zone. So the fact that these offer principal safety are a way to insulate some of your dollars from any type of negative market event. Yes, if the market goes to the moon, that we may be sacrificing some gains, but again, we're not at risk of upside market volatility. It's downside market volatility that creates the sequence of return risk for pre-retirees and retirees. More importantly, one of the biggest things that everybody approaching retirement wants to figure out is income and cash flow. So these types of products, the annuities with an income rider benefit, you can add a benefit and cover both yourself and your spouse. So if you're looking for a way as a couple to plan and coordinate income, most people are going to be talking about Social Security and how to best claim Social Security for spouses. Beyond that, if you have pensions, those are phenomenal, but a lot of people don't have pensions. So they may want to consider looking at an annuity strategy to add another layer of income that will be a pension-like income stream for the household, so that you not only have a coordinated income plan for the household, but now you start to have income plans for a surviving spouse. So this is a way that you can begin looking at, hey, should we consider using some of our assets to create another income stream that is predictable and will function like a paycheck during our retirement years. A third way that you can consider looking at a fixed index annuity is for people who have pensions. A lot of pension benefits are phenomenal, but if you have a pension, I would encourage each and every person to do some analysis on your pension plan before you claim. There are some pension plans that are really good and they still offer very attractive payouts, but But if you have a pension plan, the payments, if you will, are going to have to be, taken care of by that company. So what is your confidence level in that company or that business being able to cover those payments for the rest of your life or the rest of your spouse's life? Also, you want to consider what are the payout options if you want to have 100% survivorship. In a lot of pension plans, the highest payout amount is a single life annuity. Whereas if something were to happen to you, if it's your pension, there may not be any benefit for your spouse to survive. And I know a lot of people don't want that. They want their spouse to be taken care of. So you want to evaluate the payment options that your pension offers versus the payment options that you could use in a private annuity. Are you able to duplicate or possibly even improve the payments by using an annuity strategy instead of using the pension strategy that is available to you? Lastly, pretty simple. Sometimes people have their portfolio, they have their income plan set about, but they're in a tax sensitive situation and they're accumulating cash or they're accumulating money on the sidelines. It's paying interest. Well, if you know anything about taxes, when interest hits your 1040, it's taxed as ordinary income. So if you're building up a really large reserve of funds and you're trying to, implement or execute on some other tax strategies like Roth conversions, and you need to shelter some funds, but you don't necessarily want to put it at risk. A lot of people like to have their money in CDs. Well, if you have $100,000 in a CD that's paying 4%, that 4% is going to be $4,000 that hits your 1040 every single year because it's taxable. Using an annuity or a fixed index annuity can give you that tax deferred wrapper without putting the money at risk in the market. So that's another way that these policies or these contracts can be added to an overall plan and add some value. Have you ever had a fixed index annuity explained to you before? Drop a note in the comments and let me know how it was presented. These types of contracts are explained so differently by so many different types of advisors. I'd love to hear how it was explained to you. If you want to explore whether or not this type of contract makes sense for you, I highly recommend talking to a financial professional that understands annuities and also does comprehensive retirement income planning. If you'd like to connect with me directly, click on the link below to schedule your retirement fit call. I'd love to sit down and figure out if some of these strategies make sense for you. Thanks for watching. Don't forget to subscribe for more videos on financial planning and retirement topics.